There's a version of career progression in compliance that assumes advanced work is just intermediate work on bigger customers. Larger balances, more complex structures, more famous names. That assumption is wrong, and it produces analysts who are out of their depth precisely when the stakes are highest. Advanced EDD is a different kind of thinking. At the intermediate level, you learn to test a customer's explanation against evidence, rather than simply recording it. At the advanced level, you're working on the files where the evidence itself is contested, where the customer has the resources to construct a plausible and internally consistent account that is nonetheless false, and where the people whose wealth you're examining have every incentive and every means to make illicit funds look legitimate. The customers who reach advanced EDD are, by definition, the ones a firm most wants and most fears: a former head of state's family office, a technology founder whose fortune is real but whose banking history includes 3 jurisdictions that no longer cooperate, an industrialist from a resource-rich country whose wealth is entirely consistent with his stated business and also entirely consistent with 2 decades of state capture. These are not cases you resolve by collecting one more document. They're cases you resolve by forming a defensible judgment about probability under conditions of genuine uncertainty. I've spent a large part of my career on exactly these files, and the thing I most want to convey in this course is that advanced EDD is an exercise in disciplined skepticism, not paranoia and not credulity. The credulous analyst accepts the family office's narrative because it's polished and the lawyers are expensive. The paranoid analyst rejects everyone from a high-risk jurisdiction on principle. Neither is doing the job. The job is to hold the uncertainty squarely, gather what can be gathered, weigh it properly, and reach a conclusion you can defend to someone who wasn't in the room. The point here, advanced EDD is about defensible judgment on the hardest files, where the evidence is contested and the customer is sophisticated, not about applying intermediate techniques to wealthier people. One of the most persistent confusions in EDD work is about the standard of proof. Analysts often carry an unstated assumption that they need to be sure that to decline or exit a relationship, they must effectively prove wrongdoing. That assumption is wrong, and it leads to bad decisions in both directions. You are not a court. You are not applying a criminal standard of beyond reasonable doubt, and you are not even applying a civil standard of balance of probabilities in the way a judge would. What you're actually deciding is whether the firm can be satisfied on a risk-sensitive basis, that it understands the customer's source of wealth and source of funds well enough to be comfortable that the relationship is not being used to launder the proceeds of crime or to handle the proceeds of corruption. That's a different question from, did this person commit a crime? A customer can be entirely innocent and still fail EDD because the firm cannot get comfortable with the evidence available. A customer can also be quite probably corrupt and still, frustratingly, present a file that the firm cannot decline on rational grounds because the concerns don't rise above generalized suspicion. The standard is about the firm's comfort with the risk, documented and defensible, not about adjudicating guilt. Let me put this concretely. Suppose a customer's stated source of wealth is a business sale, and you cannot obtain the sale and purchase agreement because it's held in a jurisdiction with strict secrecy laws. The customer isn't necessarily hiding anything. The document may truly be inaccessible, but the standard you apply is not, has this customer done something wrong? It's, can this firm satisfy itself to the standard its risk appetite requires that this wealth is legitimate? If the answer is no, the relationship may not proceed, regardless of whether the customer is innocent. What matters? The EDD standard is the firm's risk-sensitive satisfaction that it understands the source of wealth, not proof of criminality. Conflating the two produces both over-declining and under-declining. Professional skepticism is a term borrowed from audit, and it's exactly the right frame for advanced EDD. It means approaching evidence with a questioning mind, being alert to conditions that may indicate misstatement, and critically assessing what you're told rather than accepting it at face value. But there's a trap in it, and the trap is bias. The hardest discipline in this work is maintaining skepticism that is evidence-driven rather than driven by the characteristics of the customer. It is very easy to be appropriately skeptical of a customer from a high corruption jurisdiction and inappropriately credulous of a customer from a low corruption one, when the actual evidence in front of you might point the other way. The polished European family office may be laundering money with more sophistication than the nervous entrepreneur from a country you've been trained to distrust. I've reviewed files where the analyst applied intense scrutiny to a customer's African business interests and waved through the same customer's opaque Luxembourg holding structure without a second glance, because the Luxembourg structure looked normal. Normal looking is not the same as low risk. Some of the most effective money laundering in the world runs through structures that look entirely normal, precisely because looking normal is the point. The corrective is to anchor your skepticism to specific evidential concerns rather than to customer characteristics. Instead of "this customer is from a high-risk country, so I'm suspicious," the disciplined formulation is "the source of wealth documentation has these specific gaps, and those gaps matter because of these specific typologies." The first is bias wearing the costume of diligence. The second is professional skepticism. There's a second dimension to this, which is that skepticism has to be applied to the customer's advantages as well as their disadvantages. When a customer produces a beautifully assembled file, audited accounts, legal opinions, tax residency certificates, wealth reports from a private bank, the natural human response is to relax. A professional skeptic does the opposite. A file that has been assembled to be persuasive deserves more scrutiny of its underlying substance, not less, because you have to ask who assembled it and what they were trying to achieve. Takeaway: professional skepticism means anchoring doubt to specific evidence rather than to customer characteristics, and applying more scrutiny, not less, to files that have been professionally assembled to persuade. Advanced EDD lives or dies on how well you weigh evidence. And weighing evidence is a skill that most analysts are never explicitly taught. They're taught to collect it. They're rarely taught that a document is not a fact, and that the weight you give a piece of evidence should depend on where it came from, who produced it, and whether anything independent supports it. Three dimensions govern the weight of any piece of EDD evidence. The first is reliability. How trustworthy is this type of evidence in principle? An audited financial statement from a Big Four firm carries more inherent reliability than a set of management accounts the customer prepared themselves. A government-issued tax certificate carries more than a self-declaration. A bank reference carries more than a character reference from a business associate. None of these is conclusive, but they sit at different points on a reliability scale, and you should know where. The second dimension is corroboration. Does anything independent support this? A customer's claim that they sold a business for a certain sum becomes far stronger when you can corroborate it against a public filing, a news report of the transaction, the acquirer's annual report, or tax paid on the gain. A single uncorroborated document, however official it looks, is always weaker than two independent sources that point the same way. The art of EDD is often the art of finding the second source. The third dimension is provenance. Where did this document actually come from? And could it have been manufactured or altered? A document the customer emails you as a PDF has weaker provenance than the same document obtained directly from the issuing authority. In an era where a convincing forgery costs very little to produce, provenance matters more than it used to. I've seen forged audit reports, forged bank statements, forged probate documents, and forged sale agreements, all good enough to pass a casual glance. The defense against forgery is not to become a forensic document examiner. It's to weight customer-provided documents according to their provenance and to seek independent corroboration for anything material. Worth remembering, a document is not a fact. Weight every piece of evidence by its reliability, its corroboration, and its provenance, and treat a single uncorroborated customer-provided document as the weakest form of support, regardless of how official it looks. Most analysts use source of wealth and source of funds as if they were interchangeable, and that imprecision causes real errors in advanced files. They are different questions, they require different evidence, and a file that answers one while pretending to answer the other has a gap that a regulator will find. Source of wealth is the origin of a customer's total net worth. It's the answer to, how did this person come to be worth what they're worth? It covers the whole accumulation story across a lifetime or across generations. The business built and sold, the career and its compensation, the inheritance received, the investments that appreciated. It's a biographical and financial history. Source of funds is narrower and more specific. It's the origin of the particular money involved in a particular transaction or relationship. It's the answer to, where did the money that's funding this account or this transaction actually come from right now? A customer might have a perfectly documented source of wealth, a business sold 20 years ago, and a completely unexplained source of funds, because the money arriving in the account this month came from somewhere the wealth story doesn't cover. The distinction matters enormously in advanced EDD because sophisticated laundering often exploits the gap between them. A customer establishes a credible source of wealth, genuine, documented, real, and then uses that credibility as cover for funds that come from a different, illicit source entirely. I'm a wealthy person. Here's how I got wealthy. Therefore, any money I move must be fine. That inference is exactly the one you must not make. Wealthy people launder money too, and their legitimate wealth is often the very thing that makes the laundering plausible. The disciplined approach is to answer both questions separately and explicitly. What is the origin of this customer's overall wealth, and is it credible? And separately, where did the specific funds in this relationship come from, and do they connect to that wealth or to something else? A complete EDD file addresses both. A weak one answers the easier question and lets it stand in for the harder one. Takeaway: source of wealth is the whole accumulation story. Source of funds is the origin of the specific money in front of you. Sophisticated laundering exploits the gap between them, so answer both separately and never let a credible wealth story vouch for unexplained funds. The single most common source of wealth claim you'll encounter at advanced level is the business sale. I built a company and sold it. It's common because it's often true. Genuine entrepreneurs really do create and sell businesses. And it's abused because it's the easiest large sum to fabricate a story around. A business sale can, in principle, justify almost any amount, which is exactly why it needs the most rigorous corroboration. The evidence architecture for a genuine business sale is rich, and its richness is what you exploit. A real transaction leaves a wide trail: the sale and purchase agreement, the completion statement, the flow of consideration through identifiable bank accounts, the tax paid on the gain, the legal and advisory fees, the due diligence the acquirer conducted, and often public traces, press coverage, regulatory filings, the acquirer's own accounts recording the acquisition. A genuine sale is witnessed by counterparties who had no reason to collude with the seller: the buyer, the buyer's lawyers, the tax authority, the advisors on both sides. When you evaluate a business sale claim, the corroboration you want is the corroboration that comes from those disinterested witnesses. The customer's own copy of the sale agreement is the weakest evidence because the customer controls it. The acquirer's annual report recording the same transaction at the same value is far stronger because the acquirer had no reason to misstate it. Tax paid on the gain is powerful because people rarely pay tax on fictional transactions. Press coverage from a credible outlet at the time of the sale is strong because it's contemporaneous and independent. The red flags in business sale claims cluster around the absence of these disinterested witnesses. A sale where the buyer is an offshore vehicle with no identifiable ultimate owner. A sale with no evidence of tax paid in a jurisdiction where tax would be due. A sale that left no public trace despite being large enough that you'd expect one. A completion where the consideration flowed through accounts that don't match the parties. A valuation that the underlying business plainly could not support. A small company sold for a sum its revenues and profits could never justify. Any of these means the sale, as described, is either misrepresented or fictional, and the wealth it's meant to explain remains unexplained. I reviewed a file once where a customer claimed to have sold a software business for a large sum to a buyer in another jurisdiction. The sale agreement was produced, but there was no press coverage of a transaction that size in that sector. The buyer had no web presence and no filed accounts. No tax appeared to have been paid, and the customer couldn't explain who at the buyer had negotiated the deal. Each of those is a missing disinterested witness. Collectively, they meant the sale could not be corroborated by anyone who wasn't the customer, and the wealth remained unexplained. The point here, a genuine business sale is witnessed by disinterested parties: buyers, tax authorities, advisors, the press. Corroborate against those witnesses, treat the customer's own documents as the weakest evidence, and read the absence of independent witnesses as the central red flag. Inherited wealth presents a distinct challenge because the event that generated the wealth may have happened decades ago in another country to someone who is now dead. The customer in front of you may be entirely legitimate and still unable to fully document the origin of family money that predates modern record-keeping. At the same time, it's old family money is a classic laundering narrative precisely because it's hard to disprove. The analytical task with inherited wealth is to follow the chain back as far as it can credibly be followed, and to be candid about where the documentation truly ends versus where the customer would prefer it to end. There's a difference between the records from the 1950s no longer exist and the customer doesn't want to discuss where the money came from. Both produce a documentation gap, but they're not the same, and you distinguish them by how the customer engages with the parts of the chain that can be documented. For a genuine inheritance, the recent links in the chain are usually documentable even when the distant origin isn't. There should be a death, and deaths generate records. A death certificate, a will, a grant of probate, an estate administration. There should be a transfer of assets from the estate to the beneficiary, and that transfer leaves a trail. There should be a period during which the deceased held and grew the wealth, and that period should be at least partially evidenced. You may not be able to document how great-grandfather made his money in 1930, but you should be able to document that the estate existed, that it was administered, and that the customer received from it what they claimed to have received. The red flags in inherited wealth cluster around a chain that's broken at the recent end rather than the distant end. If the customer can tell you a rich story about a great fortune 3 generations ago, but cannot produce a will, a probate document, or any evidence of the actual transfer to them, the problem isn't the age of the wealth. It's that the recent documentable links are missing. Illicit funds are sometimes dressed as inheritance precisely because the story reaches back beyond the reach of records, but the dressing usually fails at the recent end, where records should exist and don't. There's also a scale question specific to generational wealth. Family money compounded over generations can grow substantially, but it grows at rates that are ultimately bounded by investment returns over time. When a customer claims that a modest family inheritance has become an enormous fortune without a clear intervening wealth-generating event, a business, a career, a specific investment, the arithmetic itself becomes a red flag. Money doesn't become vastly more money on its own without either time, risk, or an explanation. Worth remembering, for inherited wealth, follow the chain back to where records truly end, and distinguish that from where the customer wants the questions to end. The recent links, death, probate, transfer, should be documentable even when the distant origin isn't, and a chain broken at the recent end is the real red flag. Investment gains as a source of wealth occupy a peculiar space because they can be entirely genuine and are also uniquely difficult to corroborate and uniquely easy to fabricate. I made my money trading, or my investments appreciated, is a claim that, unlike a business sale, may leave a thin external trail even when it's completely true. This makes it both a legitimate source of wealth and a favored cover story. The key analytical move with investment wealth is to distinguish the claim of gains from the evidence of gains, and to insist on the underlying records rather than the summary. A customer who really built wealth through investing has account statements, contract notes, custody records, and a documentable history of positions and returns over time. The wealth didn't appear as a lump sum. It accumulated through a series of transactions that a custodian or broker recorded. Those records are the evidence. A summary statement of current net worth or a self-prepared performance history is the claim, not the evidence. Where investment wealth claims tend to fail is in the plausibility of the returns and the documentation of the starting capital. Someone who claims to have turned a modest sum into a vast fortune through trading is claiming returns that, if real, would place them among the most successful investors alive. And such returns, sustained over time, are extraordinarily rare and usually leave a professional trail. More often, the claim trajectory is arithmetically implausible. The starting capital was too small, the period too short, or the returns too consistent to be credible. And crucially, the starting capital itself has to come from somewhere. Investment gains explain how money grew, not where the initial money came from. And a customer who explains the growth but not the seed has left the actual source of wealth unexplained. There's a particular version of this involving private or illiquid investments, early stakes in companies that later became valuable, property bought cheap and sold dear, holdings in ventures that appreciated. These can be genuine and transformative. They can also be impossible to corroborate independently and are therefore attractive as cover. The discipline is the same. Seek the contemporaneous records of the original acquisition, the holding period, and the eventual realization from custodians, registries, or counterparties who aren't the customer. An early shareholding that made a fortune should appear in a company's historical cap table, share registry, or filings. If the only evidence that the customer held the stake is the customer's word, the wealth is uncorroborated. Takeaway: with investment wealth, insist on the underlying transaction records from custodians and registries, not the customer summary. Test the returns for arithmetic plausibility, and remember that gains explain how money grew, not where the seed capital came from. An unexplained seed is an unexplained source of wealth.